Please like, share, and subscribe. Wishing you happiness and good luck every day.
Picture this, it's 1999. The internet is absolutely booming, stocks are going through the roof, and this new digital economy is promising to change, well, everything. But for one of the world's most famous investors, Warren Buffett, it was a total disaster. So how did the guy famous for buying Coca-Cola and candy companies handle the biggest tech revolution in a generation? We're about to break down the deals that turned a potential career-ending crisis into an absolute masterclass in investing.
I mean, just look at this chart. It tells the whole story. While the dot-com party was in full swing, the stock price for Buffett's company, Berkshire Hathaway, was in an absolute freefall. It plummeted from over $80,000 a share down to nearly $40,000 in less than a year. The market was basically saying, Buffett's time is over.
And wow, the critics were just relentless. The consensus on Wall Street was crystal clear. Value investing, the whole idea of buying solid, profitable companies at a good price, that was a relic. Buffett, who was very open about not understanding these new tech companies, was painted as this old man playing a game that was completely out of date.
Which brings us to the big question, right? While pretty much the entire world was writing him off, Buffett was quietly preparing his next move. So how did he not only survive the crash that was coming, but actually use it to build one of the most respected companies and greatest fortunes in modern history?
Okay, so to really get Buffett's genius here, first we have to understand the madness. The late 90s weren't just optimistic. They were an era of what the Fed chairman at the time, Alan Greenspan, famously called irrational exuberance. The core belief was really simple, and it was really seductive. The internet had changed all the rules, and the old ways of doing business and investing, they just didn't apply anymore.
And this is where things just get wild. Forget about profits. I mean, most of these new dot-coms didn't have any. Investors were so completely swept up in the hype that they were paying 10 times a company's annual sales. It was a speculator's paradise, totally disconnected from the basic fundamentals of how you actually run a business.
And this slide just lays out the contrast perfectly. On one side, you had companies like Pets.com and Webvan just burning through cash on stuff like Super Bowl ads, only to go completely bankrupt within a year or two. And on the other side, you had the typical Buffett company, profitable, stable, maybe a little boring, but built to last for decades.
So right as the mania was hitting its absolute peak, Buffett decides to issue a public warning. In a now-famous 1999 article for Fortune magazine, he pointed to a survey showing that the least experienced investors expected the stock market to return over 22% every single year. Buffett knew this was a mathematical impossibility.
While everyone else was caught up in complicated tech jargon, Buffett's logic was just devastatingly simple. He broke it down like this. The entire U.S. economy grows at about 5% a year, right? That's real growth plus inflation. Well, corporate profits are just one piece of that big economic pie. They can't magically grow faster than the whole pie forever. So it was a mathematical certainty that these insane stock market returns had to come back down to that 5% reality.
So here's the crucial point. With this one sentence, Buffett just cuts through all the hype. It doesn't matter if you're talking about a railroad, a software company, or a website that sells pet food. At the end of the day, a company's value is tied to its ability to generate actual cash profits. That was the rule then, and it's the rule now.
Okay, so while the rest of the world was chasing these dot-com fantasies, what were Buffett and his partner Charlie Munger doing? They were sharpening their pencils and getting back to the basics that had made them rich. They focused on two core ideas that just cut through all the noise: the moat and the price. First up, the economic moat. You've probably heard this term. It's his famous metaphor for a powerful, long-lasting competitive advantage. We're talking things like a brand that everyone loves, a super efficient way of making things, or a network that just locks customers in and keeps competitors out. For Buffett, this was the real key to long-term value, not just being in a fast-growing industry.
And here it is, his ultimate test for a great business: pricing power. Can a company raise its prices without its customers immediately running to a cheaper alternative? If the answer is yes, then you are looking at a company with a really strong moat and a very, very good business.
So, armed with these principles, and a whole lot of cash he'd saved by not buying those overpriced tech stocks, Buffett went on a shopping spree as the bubble started to burst. And the companies he bought were the exact opposite of the dot-com darlings. They were, boring. But they were absolutely brilliant.
His first big move was a real head-scratcher: MidAmerican Energy. As the tech bubble was imploding, Buffett announces he's buying a regulated public utility.
Wall Street was completely baffled. I mean, these are the tortoises of the business world, known for slow, predictable growth, the polar opposite of those dot-com hares.
But Buffett saw what everybody else missed. Let's just break down these numbers, because they're incredible. Berkshire's initial investment was about $5 billion. Over the next 25 years, that boring utility generated and reinvested $42 billion in profits. And today, it's a cash machine, pouring $2 to $4 billion into Berkshire's bank account every single year. It wasn't boring. It was a brilliantly hidden treasure.
And you know what's wild? The deal itself didn't happen in some stuffy boardroom. It started when Buffett's old friend Walter Scott pulled him aside at his sister's party. They talked for a minute, and based on that trust and a quick look at the public numbers, Buffett just said yes. A handshake and a relationship were worth more than an entire army of analysts.
Okay, his next move was just as unglamorous and, you guessed it, equally profitable. In 2001, Berkshire bought Shaw Industries, not a software company, not a fiber optic network, but the world's largest carpet manufacturer.
Buffett paid about $2.4 billion for Shaw. And get this, in just the first 9 years, it had already returned $1.9 billion of that back to Berkshire in pure profit. And just look at that key metric. In 2004, it earned a massive 25.6% return on tangible equity. To put that in simple terms, for every single dollar of physical stuff the company owned, it was generating over 25 cents in profit. That's not just good, that's a financial powerhouse hiding in a boring industry.
Now, this quote is actually from a different deal, but man, it just perfectly captures Buffett's unique approach. He almost never does what we think of as traditional due diligence. He doesn't send in teams of lawyers and accountants to pick everything apart. He evaluates the business, and most importantly, he evaluates the character of the managers. If he trusts the people, the deal gets done. It's that simple.
So as the dot-coms all turned to dust, Buffett's weird collection of boring businesses, utilities, carpet makers, furniture stores, brick companies, they all started to thrive. The man who was called out of touch was about to be proven right on a truly historic scale.
And here it is. This is the payoff. This single image tells the entire story. On the left, you've got the storm, that painful dip in 1999 when all the critics wrote him off. And on the right, that's the sunshine after the storm, the result of patience, discipline, and unwavering belief in his principles. Just a steady, relentless, and absolutely spectacular climb for the next quarter century.
Let's really put that climb into perspective, because the numbers are just insane. Imagine you had bought a single share of Berkshire Hathaway at its low point in 2000 for around $40,000. Today, that one share would be worth nearly $700,000. It's more than just a great return, it's probably the single greatest vindication of an investment philosophy in modern history. So what are the big lessons here? What can we actually take away from this? First, you got to stick to your principles, even when the crowd thinks you're crazy. Second, remember that hype always fades, but earnings are real. Third, bet on people. Trustworthy management is the ultimate asset. Fourth, look for those economic moats. And finally, the most famous lesson of all, be greedy when others are fearful. And that leaves us with a final thought. Buffett's greatest triumph came from looking where nobody else was, at the boring, the overlooked, and the unloved. It kind of makes you wonder, in our own era of hype and speculation, what are the truly great, durable, and boring opportunities that everyone else is completely missing?
All right, let's get into it. Today, we are diving into one of Warren Buffett's biggest and, honestly, one of his most overlooked masterpieces. It's a multi-billion-dollar bet on the decidedly unsexy world of public utilities. This is the incredible story of how Berkshire Hathaway built a $90 billion energy empire pretty much right under everyone's nose.
So to really get this deal, you have to picture it. Go all the way back to 1999. The internet was absolutely changing the world, and the stock market was just in a total frenzy. You know, tech stocks, dot-coms, telecom companies, those were the darlings of Wall Street. Everybody was chasing the industries of tomorrow, and anything that looked old or slow or, let's be honest, boring was basically left for dead.
And this quote, it just perfectly captures the insanity of that moment. Buffett and Munger, they're sitting on billions in cash from their insurance businesses, and they just couldn't find a single thing to buy at a rational price. All the wonderful businesses they loved were trading at these just absurd valuations. So what did Berkshire do? They waited. They were this giant financial machine with nowhere to put its capital. And that, right there, brings us to the big question. In the middle of all this tech mania, why on earth would the world's greatest investor decide to pour billions into a highly regulated, capital-intensive utility company? I mean, this is a business where your returns are literally capped by the government at around 10 to 12%. To a lot of people at the time, it seriously looked like Buffett had lost his mind. But as we're about to see, it was a move of pure genius.
You know, the funny thing is, the story doesn't even really start with Buffett. It starts with this remarkable group of people. And incredibly, 3 of them were from Omaha, just like him. To understand the deal, you first have to understand this dream team. So first up, you've got David Sokol. People described him as hard-charging and demanding. He was this brilliant, no-nonsense operator, the kind of guy you'd call when a business was completely floundering. In fact, Buffett would later use him as his personal Mr. Fix-It to turn around other struggling Berkshire companies, like NetJets. Sokol, you gotta remember, was the real driving force behind this whole story. Then there's Walter Scott Jr. Now, he was a lifelong friend of Buffett's. They actually chased the same girl in high school, and, as Buffett liked to joke, the best man won. Scott was this fabled construction magnate who ran the Peter Kiewit Company, and his office was literally right below Buffett's. He was the quintessential builder, not just of buildings, but of businesses and his whole community. He's the one who provided that crucial early capital and the connections to get this thing off the ground. And rounding out the team is Greg Abel. He's this fiercely intelligent but really humble Canadian accountant who joined the company when he was just 29. He became Sokol's indispensable partner, the calm, efficient operator who could handle Sokol's demanding style. He just had this knack for seeing where a business needed to go and figuring out exactly how to get it there. And, as we're going to see, his journey ends at the very, very top of Berkshire Hathaway. And you can see right here what this team could do. Long before Berkshire was even in the picture, Sokol, Scott, and Abel took this tiny, near-bankrupt geothermal company called Cal Energy and, just through shrewd acquisitions and incredible operational skill, turned it into an energy powerhouse. The growth was just phenomenal. They had built this truly world-class operation. All they needed now was a permanent home for it. So this is what set the stage for the perfect partnership. On one side, you had this fast-growing, brilliantly managed energy company. And on the other, you had Buffett's patient, cash-rich Berkshire Hathaway. It was truly a match made in business heaven. If you want to understand why Sokol was so desperate to get out of the public markets, you just have to read this piece of advice he was getting from Wall Street brokers. See, back in the dot-com era, investors rewarded hyperactivity, not rational long-term thinking. Companies like Enron were making 2 or 3 deals a month. Meanwhile, Sokol's team was making 1 or 2 a year, and their stock was getting punished for it. He just got so tired of the obsession with quarterly earnings and all the pressure to make bad long-term decisions. So the symbiosis here was just perfect. Sokol's company, which was by then called MidAmerican, needed a permanent home with a patient owner, somewhere it could reinvest for the really long term. At the same time, Berkshire needed a massive, capital-hungry business where it could deploy its billions for a steady, reliable return. You know, a guaranteed 10 to 12% on billions of dollars started to look a whole lot better than gambling on tech stocks at 50 times earnings. Now, the way Buffett structured the deal, it was pure genius. There was this old law, the Public Utility Holding Company Act, that basically prevented an unregulated company like Berkshire from having voting control. So what did Buffett do? He bought a huge economic stake with preferred stock, but he cleverly kept his voting stake just under 10%. He was betting that the law would eventually change. And guess what? It did. And when it did, he converted his shares, took control, and then just patiently built his ownership all the way to 100% over the next 2 decades. So, with MidAmerican now safely inside Berkshire and renamed Berkshire Hathaway Energy, or BHE, the real work could begin. And this, my friends, is where the story goes from being a great investment to a truly legendary one. So what does this big number represent? That is the total amount of dividends BHE paid to its parent company, Berkshire Hathaway, for the first 25 years. 0. Not a single penny was sent back to Omaha. And why is that? Because Buffett and Sokol knew that every single dollar of profit could be reinvested right back into the business to earn that steady 10 to 12% return, compounding value year after year after year. And right here, you can see the result of that strategy. Over on the left, you can see the capital expenditures, that's the reinvestment, was consistently higher than the profits. And on the right, you see the direct result, this absolutely staggering climb in total assets, from around $11 billion in 2000 to over $120 billion today. It was a simple but incredibly powerful formula. Earn and reinvest.
And boy, did this reinvestment pay off. This chart shows Berkshire slice of BHE's annual net earnings. Look at that. It grew from less than $500 million to a peak of nearly $4 billion a year. The total profit that was generated and reinvested over those 25 years was an incredible $42 billion. But that reinvestment didn't just go into buying more of the same old stuff. No way. BHE quietly became a leader in the energy transition. Just look at this breakdown from 2023. Wind power is their single largest source of energy. They started investing heavily in wind way back in 2004. And today, BHE is an absolute titan of renewable energy, all of it funded by that relentless reinvestment engine. So what's the ultimate legacy of this deal? For Berkshire, for the key players who made it all happen, what did it all mean in the end? Well, for one, the BHE deal really cemented one of Berkshire Hathaway's most powerful competitive advantages, its reputation as the buyer of first resort. Buffett proved he was the ideal owner. He trusted great managers like Sokol and Abel, he gave them the freedom and the capital to execute their vision, and he promised them a permanent home. And that reputation means that today, when great family-owned businesses are looking to sell, they often call Buffett first. And what about our dream team? Well, David Sokol eventually resigned under some controversy, but he went on to build his own investment empire. Walter Scott remained a close friend and a board member right up until his death, donating nearly all of his multi-billion-dollar fortune. And Greg Abel? Well, his quiet competence and brilliant execution at BHE propelled him straight to the top. He is now the vice chairman of all non-insurance operations and Warren Buffett's hand-picked successor as CEO of Berkshire Hathaway. You know, this story is just packed with incredible lessons. It shows how Buffett had to adapt his strategy. He went from buying great companies at a good price to buying good companies at a fair price because he needed to deploy huge amounts of capital. The deal shows that trust between an owner and managers can be a massively powerful economic engine. And maybe the biggest lesson of all is that a truly long-term view can unlock just staggering value in industries that everyone else has dismissed as boring. And this is the result of that long-term view. From an initial investment of about $2 billion for control, Berkshire Hathaway Energy is now estimated to be worth around $90 billion. An absolutely monumental return, born from a contrarian bet on a boring industry during a time of complete market mania. And that really leaves us with a final thought, doesn't it? In our own era of frantic speculation and obsession with the next big thing, this story is just such a powerful reminder. So I'll leave you with this question. What's the next boring industry out there right now, overlooked and undervalued, just waiting for the right combination of patient capital and brilliant management to transform it? Thanks so much for tuning in.
Welcome to The Explainer. Today, we're going to unpack one of Warren Buffett's most puzzling deals. It's a story that really goes to show that even the absolute greatest investors can and do make mistakes.
Okay, let's start with this number right here, $386 million. That's how much Berkshire Hathaway, led by the legendary duo of Warren Buffett and Charlie Munger, paid for a company called CORT Business Services all the way back in the year 2000.
So, how on earth did a deal backed by the sharpest minds in finance turn into more than 2 decades of just, well, sheer disappointment? It's a really fascinating story about a great company that was stuck in a terrible business. And trust me, it holds some powerful lessons for all of us.
To solve this mystery, we've really got to put ourselves in their shoes. What did Buffett and Munger actually see in CORT? I mean, why were they so interested in a furniture rental company in the first place?
And you know, what's wild is that on paper, CORT looked like a textbook Buffett investment. I mean, it was the undisputed leader in its field, America's #1 furniture rental firm. The business model? Super simple and sound. You buy furniture, you rent it out for about 3 years, and then you sell it off for a little profit. It was led by Paul Arnold, a manager with nearly 3 decades of experience at the company, and the price? A PE ratio under 13. This was at a time when the rest of the market was going absolutely crazy in the dot-com bubble. On paper, this thing looked like a home run.
And look, you don't have to take my word for it. Buffett himself confirmed this exact thinking. He saw an unglamorous but solid business, a top-tier manager he could trust, and a sensible price tag. All the key ingredients for a classic Berkshire Hathaway success story seem to be right there.
But here's the thing. CORT wasn't just some simple, sleepy little company. No way. This company had a wild history long before Berkshire ever showed up on the scene. This was a company that knew how to survive.
Khan's story started way back in '72, but things got really complicated in the late '80s when it got swept up in that whole corporate raiding craze and was taken over in a leveraged buyout. This just buried the company in an enormous pile of debt. So in '92, Paul Arnold takes the helm, and he expertly navigates the company through these really treacherous financial waters, eventually taking it public in '95. Then, get this, a failed attempt by management to buy the company themselves in '99 is what put it on Buffett's radar. This was a battle-hardened veteran of the corporate world.
I mean, this quote from the Washington Post just perfectly captures the chaos. CORT had been through it all. It wasn't just a business, it was a survivor that had endured pretty much every financial fad you could possibly imagine. And you have to think that this proven resilience, this ability to take a punch and just keep on going, was something Buffett and Munger found incredibly attractive. Okay, so we've got a survivor of a company and an outstanding manager. So what gives? Where did it all go wrong? Well, the answer wasn't inside the company. The hidden trap, the fatal flaw, was the industry itself.
And this right here, this is the heart of the problem. CORT was the best house in a really bad neighborhood. It was the biggest player, it had the best brand, and it had the best management team. But the furniture rental industry, it was brutal. There were countless direct competitors in every single city, and it was ridiculously easy for a new mom-and-pop shop to start up with just a truck and some inventory. And on top of that, customers could always choose to rent to own or just go buy cheap furniture instead. All of this intense competition just completely destroyed any real advantage CORT had.
You know, this all boils down to one absolutely critical concept: pricing power. For an investor like Buffett, pricing power is the holy grail. It's the moat around the castle that keeps all the competitors out. It means you have a product or service so valuable that you can raise prices without your customers leaving you. But Corinth, it had none, zero. Because customers always had a cheaper alternative, CORT could never really raise its prices much higher than its costs. And that is the hidden trap that would plague this investment for the next 20 years.
All right, so we've talked about the theory, but the numbers? Oh, the numbers don't lie. They tell a very, very clear story of struggle and serious underperformance.
You know, things actually started out pretty well. In the first 10 months of 2000, CORT made nearly $30 million in profit. But then, the dot-com bubble burst, and profits just completely collapsed, even turning into a loss by 2003. The business that Charlie Munger had initially thought was recession-proof turned out to be anything but. When the economy soured, so did CORT's business.
So the company managed to claw its way back to being profitable in the mid-2000s. But then, bam, the 2008 financial crisis hits, and it hits CORT even harder. The business fell into another loss in 2009, with Charlie Munger grimly admitting that business was melting away faster than CORT can fix it. It was a brutal, brutal confirmation that the company's fate was tied directly to the health of the wider economy. Then we get to the 2010s, which were finally the, good years, if you can even call them that. The company finally strung together a series of decent results. But even here, we got to put it in perspective. After all that chaos, it took more than a decade for this $386 million investment to generate what you could only describe as a just about respectable return. It was hardly the home run they were hoping for.
After 2016, CORT's results became so small they weren't even reported separately in Berkshire's annual reports anymore. But you can piece together the story from these little hints. In 2017, Buffett notes lower earnings. In 2020, a decline in earnings. And maybe the most telling thing of all, the employee count, which used to be over 3,000, fell to a new low of under 2,000 by 2022. The silence really spoke volumes.
So, after all of that, what's the final verdict on this nearly $400 million investment? And more importantly, what are the key takeaways from this whole cautionary tale for the rest of us? When you really break it down, the story of CORT boils down to three powerful lessons. First, the structure of the industry is absolutely critical. A lack of barriers to entry, like in furniture rental, can basically poison the well for everybody. Second, while a great manager like Paul Arnold is essential, they can't perform miracles in a fundamentally broken industry. And third, be very, very skeptical anytime you hear the term recession-proof.
At the end of the day, the story really comes down to this. CORT was a well-run operation, the best boat in its class, with a fantastic captain at the helm. But it was trying to row upstream against the powerful, relentless current of a terrible industry. And in the long run, the current always wins.
And that leaves us with one last provocative question to chew on.
When you're making a big decision, whether it's an investment or something else in your life, what do you bet on? The talent of the jockey or the speed of the horse? The CORT story offers a pretty compelling answer, don't you think?
So let's dive into one of Warren Buffett's most incredible and honestly most dramatic investments, his long-running stake in Moody's, the credit rating agency. I mean, this story really has it all. We're talking brilliant insight, a crazy speculative mania, a devastating crash, and of course, some truly timeless lessons about what value actually means. Okay, let's just start with the headline number because, wow, it's a real jaw-dropper. From an initial investment of just under $500 million way back in 2000, Berkshire Hathaway has pulled in a profit of over $10.2 billion. That is a 20 times return on their money, and get this, they still own a massive chunk of the company. So that leads us to the big question, right? How on earth do you find an opportunity like that? Is it just getting lucky, or is there a process you can actually follow? Well, to figure that out, we're going to trace Buffett's entire journey with Moody's, from the day he bought it through the absolute chaos of the 2008 financial crisis and into the recovery.
All right, so here's how we're going to break this all down. We'll start with Buffett's core idea, the economic moat. Then we'll look at why he thought Moody's was such a wonderful business. After that, we'll ride the insane wave of the subprime boom, watch it all come crashing down, and then, most importantly, pull out the crucial lessons from this whole saga.
You know, to really understand this Moody's investment, you have to start with the single most important concept in Buffett's entire playbook, and that's the idea of an economic moat. Seriously, this is the key that unlocks his whole way of thinking about the market.
It's actually a pretty simple idea. An economic moat is just a durable competitive advantage. It's the thing that protects a company's profits from being chipped away by competitors. So you think of the business as this great economic castle, right? Well, the moat is what keeps the invaders, all the competition, from getting in and taking the treasure. It ensures that castle can keep generating cash for its owners for a long, long time.
And here it is, straight from the man himself, back in 1995. He's not just looking for a decent company. No. He's looking for an impenetrable fortress, a business so well defended that it can just stand there for decades, cranking out predictable profits for its shareholders.
Now, this focus on quality, this was a huge shift for Buffett, and it was mostly because of his partner, the brilliant Charlie Munger. Munger was the one who convinced him to move past the old-school cigar butt style of investing, buying crummy businesses for super cheap prices. Instead, Munger said, let's buy wonderful, high-quality businesses, even if we have to pay a fair price for them. And Moody's? It was the perfect example of this new way of thinking.
All right, so keeping that philosophy in mind, what exactly did Buffett see in Moody's that made him say, yep, that's a wonderful business? This was back in 2000 when its parent company, Dun & Bradstreet, spun it off. What did that moat actually look like? Well, first off, just look at its history. Moody's wasn't some hot new tech startup. It was founded in 1900. It had been the gold standard for bond ratings for almost a century. That rock-solid reputation was the foundation of its moat. See, if a company or a government wanted to issue bonds, they basically had to get a rating from Moody's, or one of its two big competitors, S&P and Fitch. If they didn't, investors wouldn't take them seriously. And that created this incredibly powerful three-firm oligopoly. And having an oligopoly like that leads directly to what Buffett thinks is the most important thing in a business: pricing power. Because those bond issuers had almost nowhere else to go, Moody's could just keep raising its prices without really worrying about losing customers. Buffett has this great test. He says if you have to pray before you raise your prices 10%, you've got a terrible business. Well, let me tell you, Moody's didn't have to pray. And as Buffett says, that's the sign of a very, very good business. And the numbers totally backed this up. When Buffett was looking at the company, he saw this just beautiful, steady climb in earnings per share. It had more than doubled in just 4 years. This kind of strong, consistent growth is why he was willing to pay a price-to-earnings multiple of 21. Now, a PE of 21, that's a pretty steep price for a traditional value guy. But for a truly wonderful business with a deep moat, Buffett saw it as a fair price to pay. Okay, but this is where the story gets really wild. This already great business was about to catch a massive, unforeseen tailwind. The investment didn't just perform well, it turned into an absolute rocket ship. And it was fueled by something that, at the time, nobody really understood. And the fuel for that rocket? It was the housing boom. More specifically, the explosion in something called structured finance. And what that really means is rating these complex bonds that were backed by subprime mortgages. Just look at the dark bar on this chart. That's the structured finance stuff. It just completely dwarfs everything else. It grew almost 5 times between 1999 and 2006. Wall Street was just cranking out these mortgage-backed securities, and every single one needed a stamp of approval from Moody's. So, what did that mean for shareholders? The result was just staggering. As all that revenue poured in, Moody's stock price went vertical. It surged over 6 times from where Buffett bought it to its peak in 2007. Just let that sink in for a minute. Berkshire's $499 million investment had ballooned into over $3 billion. The castle wasn't just safe anymore, it was literally overflowing with treasure. But we all know how this story goes. That party came to a spectacular, screeching halt. In 2007 and 2008, the subprime mortgage market didn't just slow down, it completely imploded. And that created the Great Financial Crisis, which put Buffett's entire investment thesis to the ultimate test. That moat was about to get hit with a tidal wave. And the fall was just brutal. The stock crashed more than 80% from its high. The structured finance business completely vanished. Profits collapsed. And even worse, Moody's reputation was in tatters. I mean, the company was being called a key enabler of the crisis for slapping AAA ratings on what turned out to be toxic financial garbage. The very thing that made it so strong, its reputation, was now its biggest liability. So this leads to a really fascinating question. Buffett himself had said a housing bubble was forming as early as 2006. So why didn't the world's greatest investors sell his shares at the top and just sidestep that whole 80% crash? Well, his answer tells you a lot about market psychology and just how hard it is to time a mania. Buffett explained that bubbles almost always start with a solid, logical idea. In this case, that house prices generally go up over time. But then the price action takes over. People see their neighbors getting rich flipping houses and they jump in, not because of the logic, but just because the price is going up. A mass frenzy builds, and even if you know it's a bubble, like Buffett did, trying to call the exact top is almost impossible. Because, as he says, the wise do in the beginning what the foolish do in the end. That momentum can just carry things way beyond what anyone thinks is rational. So after going through that near-death experience, what are the big lessons here? This final part of the Moody's story, its recovery, is honestly where we find some of the most valuable takeaways for anyone trying to navigate the markets today. You know, the crisis really drew a bright line between investing and speculating. An investor, as Buffett sees it, focuses on what an asset can produce over the long term, like a farm or an apartment building or a business. You honestly wouldn't care if the stock market closed for 5 years. But a speculator, they're totally focused on the price, just hoping someone else will pay more for it tomorrow. The housing bubble was pure speculation. Buffett's purchase of Moody's, that was an investment in a real, durable business. And here's the proof right here. This is where the rubber meets the road. Look what happened after the crisis. That structured finance business, in black, it collapsed, and it never came back to those bubble-era highs. But the core business, rating corporate bonds, banks, public finance, it steadily recovered and then started to grow again. The moat, yeah, it was tested and it was damaged, but it wasn't broken. The fundamental need for credit ratings was still there, which proved the business was way more resilient than its stock price suggested during the panic. So let's just wrap up the key takeaways from this incredible story. First, focus on wonderful businesses with strong economic moats. They're your best defense. Be super careful when a good idea, like house prices go up, turns into a speculative frenzy. Know whether you're investing in a business or just betting on a price. Accept that trying to time the market perfectly is a fool's game. And finally, a truly great business, one with a deep moat like Moody's, can not only get through a crisis, but can actually come out even stronger. And that leaves us with a final thought. The Moody story is proof that a company's competitive advantage, its moat, is the ultimate source of its long-term value. Despite all the chaos, its essential role in the markets was still there. So the real question for all of us today is this. When you look at the market right now, where are the castles with the deepest, most durable moats? All right, so today we're going to pull back the curtain on one of Warren Buffett's most brilliant trades. I mean, this thing is a total masterclass in buying low, selling high, and maybe most importantly, spotting a catastrophe before anyone else even smelled smoke. And the company at the center of this whole story? Well, it's not some flashy tech giant. It's a business you've probably driven past in a strip mall 1,000 times. Let's just start with the final number, because it really sets the stage for everything else. $513 million. Think about that. That's the estimated, and get this, tax-free profit that Berkshire Hathaway made on this one single investment. It's a number so huge it's almost hard to wrap your head around, but man, what a win. So, where did this absolutely colossal profit come from? H&R Block. Yep, that H&R Block. The place people go to get their taxes done. It just begs the question, right? How in the world did Warren Buffett find a $500 million opportunity in what most people would call a pretty steady, maybe even boring business? Well, the answer? That's where the genius comes in. Okay, so here's how we're going to break this all down. First, we'll look at the perfect trade itself. Then, we'll dig into the moat of the brand, what caught Buffett's attention in the first place. After that, we'll see how the company diversified itself right into danger. We'll cover how Buffett was reading the storm clouds, then his great escape. And finally, we'll wrap up with the big lessons we can all take from a master. So let's talk about the trade itself, because honestly, the timing is just beautiful. Okay, so picture it. It's 2000, 2001. The dot-com bubble is bursting, everyone's pessimistic. And what does Berkshire Hathaway do? They quietly start buying up a huge stake in H&R Block, about $255 million worth. Then, and this is the incredible part, over 2005 and 2006, they sell every single share for around $768 million. They got out completely, right before the 2008 financial crisis blew up the exact part of the business H&R Block was betting on. Talk about a perfect entry and an even more perfect exit. All right, section 2, the moat of brand. To really get why Buffett bought in, you have to understand what he saw. And it wasn't just numbers on a spreadsheet, you know? He saw this incredibly powerful, almost invisible asset that H&R Block had built up for decades in the mind of every American, its brand. And that brand really started with the unbelievable drive of its co-founder, Henry Block. I mean, this guy flew 32 combat missions as a B-17 navigator over Germany and World War II. When he came home, he wasn't just looking for a quiet life. As he put it himself, he was determined to build something that would last. And man, did they build. They started with just a $5,000 loan for a little bookkeeping business, and then they kind of stumbled into their big break. In 1955, the IRS suddenly stops doing tax returns for free, and boom, the Block brothers were swamped with people needing help. They saw their chance and pivoted, big time. They came up with a franchise model that basically put an H&R Block in every town, and by the 70s, Henry Block was that guy on TV. You know, that friendly, trustworthy face that made you think H&R Block whenever you thought about taxes. And this right here, this is Buffett himself basically laying out his entire thesis. You think of tax preparation, you think of H&R. It's so simple, but so powerful. He saw that they had achieved what you'd call an untouchable share of mind. I mean, for millions of Americans, the thought process was literally, ugh, I gotta do my taxes, I should go to H&R Block. It wasn't even a choice, it was the default setting in their brains. And that is an economic moat you just can't buy. Okay, section 3. But here's the catch. That amazing business, that powerful moat, it had one huge problem. It was seasonal. And that one problem would push the company down a path that legendary investor Peter Lynch famously called diversification, and it would plant the seeds of a total disaster. And you can see the logic, right? I mean, for 4 months a year, from January to April, their offices were absolutely packed. But for the other 8 months, they were just burning cash on rent and overhead, so the solution seemed like a no-brainer. Hey, we've got millions of customers who trust us with their financial lives. Why don't we sell them other stuff, like mortgages, the rest of the year? And this is the key that unlocks the whole disaster, the subprime mortgage. To really juice the profits of their new mortgage business, H&R Block subsidiary basically dove headfirst into the market for these loans to people with shaky credit. There's a reason they were called non-conforming loans. They were way too risky for the government to back. But in the early 2000s, Wall Street couldn't get enough of them, and H&R Block was more than happy to keep the supply coming. And this is where Buffett comes into the picture. It's 2000, the dot-com crash is happening. And on top of that, H&R Block hits a few of its own speed bumps. So naturally, Wall Street hammers the stock. But Buffett, he looked right past all that short-term noise. He saw a great, solid business with an amazing moat that was suddenly on the discount rack. For him, the market's panic was a screaming buy signal.
And this table just shows you exactly what was happening right when Buffett was buying in. Take a look. Between 97 and 2000, the U.S. tax business, their bread and butter, is growing nicely. But then look at the mortgage operations line.
It more than tripled in that same short period. This wasn't just a side project anymore. This was becoming a high-speed chase for profits in a really dangerous game. All right, now we get to the real climax of the story. For a few years, H&R Block's strategy looked absolutely brilliant. The stock was doing great, and the mortgage division was just a fire hose of cash. But Warren Buffett, who famously reads 5 or 6 newspapers a day, was starting to see a very, very different story taking shape. I mean, just look at these numbers. The growth is absolutely staggering. The mortgage business goes from $95 million in operating earnings in 2000 to almost $700 million by 2004. By that point, the risky subprime mortgage division was making more money than their entire iconic tax business. The tail was officially wagging the dog. The company was hooked.
And this quote from their own 2005 annual report just perfectly captures the mindset of the time. We don't think it's realistic to think the secondary market would simply stop buying loans. It's just pure confidence. They'd gotten so used to the good times, they literally could not imagine the music stopping. It's the classic "this time is different" trap. So while the company's management is looking at their own spreadsheets and seeing profits go up, Buffett is, reading the world. He's connecting all these different dots. Newspaper articles about credit standards getting looser, notes about the Fed planning to raise interest rates, this general feeling of craziness in the housing market. See, he wasn't trying to be a mortgage expert. He was just an expert at seeing the big picture risk that everyone inside the bubble was getting paid to ignore.
And this brings us to the absolute masterstroke. Armed with that big picture view, Buffett didn't just trim his position or take some profits. No, he planned and executed a complete, total escape, all while the party was still raging and the music was at full blast. This chart right here is basically the smoking gun. You have H&R Block executives on their earnings calls in 05 and 06 bragging about how great the mortgage business is doing. Meanwhile, look at those bars on the chart. That's Berkshire's stake in the company. And you can see it just marching down quarter after quarter, methodically, all the way to zero. He was selling while everyone else was euphoric, a textbook Buffett move.
And what's crazy is that while Buffett was quietly getting out, the company itself started stumbling. Get this, the company that literally built its entire brand on doing taxes correctly miscalculated its own taxes by $32 million. At the same time, they had software glitches that ticked off 250,000 of their customers. These weren't just random mistakes. They were signs of a company that had totally taken its eye off the ball.
Okay, so Buffett cashes out for $768 million and walks away clean. So what happened next? Well, the aftermath is what really elevates this from just a great trade to a timeless lesson.
The collapse was total. Just like Buffett figured, the market for these subprime loans didn't just get smaller, it completely disappeared. Just look at the mortgage operations line on this table. A loss of over $1 billion in 2007, another billion-plus loss in 2008. All of those steady, reliable profits from their tax business just completely wiped out by these massive losses. Buffett didn't just make money on this deal, he dodged an absolute cannonball.
So what's the big takeaway here? This whole trade is like the entire Buffett philosophy wrapped up in one story. First, share of mind. That brand power is a real crucial asset. Second, diversification. Be super wary when a great company starts wandering into businesses it doesn't understand. Third, read the world. You gotta look beyond the company reports to see the bigger dangers. And finally, buy on pessimism, sell on optimism, which is maybe the most famous lesson of all. This whole story is so much more than just a history lesson. It's a framework, a way of thinking we can use right now. It really makes you stop and ask a pretty critical question. What great, dominant companies today are maybe making these exact same mistakes? Which ones are getting distracted, chasing the next big thing in a field they don't really get, all while everyone on Wall Street is cheering them on? The names and the industries might change, but the pattern? Well, the pattern is timeless. All right, welcome back. Today, we've got a wild story for you. It's got ambition, it's got a colossal blunder, and it's got a legendary deal at the center of it all. We're talking about how Warren Buffett, maybe the most famous investor on the planet, ended up buying the world's largest carpet company. Let's get right into it. So let's start with a number, $2.42 billion. That's what Berkshire Hathaway paid back in 2001 to buy Shaw Industries. Now, this wasn't just some casual pickup. It was a massive, massive bet on a business that a lot of people on Wall Street would have just called, well, boring. The stakes here were incredibly high. And that really gets us to the heart of the mystery, doesn't it? I mean, think about the timing. The tech bubble had just burst, everyone's losing their minds over dot-coms, and here's Warren Buffett sitting on billions of dollars, and he decides to get into floor coverings. What on earth did he see in this Georgia carpet maker that everybody else was missing?
Okay, so to really get to the bottom of this, we're going to walk through the whole journey. We'll start at the beginning, see how the Shaw Empire got built, then we'll look at the catastrophic mistake that almost tore it all down, we'll see how they staged their comeback, and then we're going to peel back the numbers, just like Buffett did. Finally, we'll check in on life under Berkshire and pull out the big lessons from this whole incredible story.
All right, let's kick things off with part one. To really understand the company that Buffett bought, you have to go way back. Back to a small town in Georgia and two brothers who had a crazy vision to completely take over an entire industry. So, our story really begins in Dalton, Georgia, the carpet capital of the U.S. It all starts in 1946 when Clarence Shaw buys this little business called the Star Dye Company. After he passed away, his son Bob takes the reins in '58 and, with his brother J.C., starts to really transform things. These guys were just relentlessly ambitious. By '67, they'd formed a holding company, and then in 1971, they took Shaw Industries public with about $43 million in sales.
And this quote right here, it tells you everything you need to know about Bob Shaw's mindset. He wasn't just making carpets. He was a fierce, fierce competitor. He saw business as a game, and in his mind, the way you win is by being faster, more efficient, and always trying to see that little bit around the corner before anyone else. That idea would shape everything they did.
So, how did they pull it off? What was the master plan? Well, the goal was brutally simple. Become the absolute cheapest producer, period. To do that, they went on a buying spree, snapping up competitors to get bigger. They integrated backwards, buying the mills that made their yarn. Then they integrated forwards, creating their own trucking and wholesale operations so they could cut out the middlemen. And on top of all that, they were always the first to jump on new technology. They controlled everything, from the yarn to the delivery truck, and that gave them a cost advantage that was almost impossible to beat. And wow, you can see the results for yourself. I mean, look at this. The '70s were tough. You had the oil crises making raw materials super expensive. But as soon as things settled down in the '80s, their low-cost machine just went into hyperdrive. The result? Their stock didn't just beat the market. It absolutely left the S&P 500 in the dust. They were a total powerhouse. But you know how these stories go. Right when they were at the absolute peak, flush with cash, super confident, the Shaw brothers made a decision that would turn into a near-fatal billion-dollar blunder. They decided to fundamentally change the one thing that had made them so successful. So just look at this. I mean, business is absolutely booming. Profits are just climbing and climbing, hitting almost $130 million by 1994. They were on top of the world. It really felt like these guys could do no wrong. But then, they made their move. And then, this happened. The difference is just shocking. Profits didn't just dip, they completely cratered. They fell by over 80% in just a few years. Sales were still going up, but the money they were making just vanished. What on earth could have gone so terribly wrong? Well, here is what they did. They decided to jump head first into retail. In 1995, they spent more than $200 million buying up 400 different retail stores. They thought it was the next logical step. But in doing so, they committed a cardinal sin of business. They started competing directly with their own customers. All those thousands of independent carpet stores that sold Shaw products were suddenly getting undercut by Shaw's own stores. The backlash was immediate. Retailers, including giants like Home Depot, just dropped them. Their market share evaporated. All right, so how do you come back from a blunder that big? Let's talk about the recovery. They were humbled, for sure, but they unwound their mistake and made some really brilliant moves that not only put them back on top, but eventually put them on a direct path to Warren Buffett's office in Omaha.
Okay, so what was the comeback plan? Well, first things first, they got out of retail. They sold the stores and went back to doing what they did best, being the most efficient carpet maker in the world. Then, in 1998, they made a total game-changing move. They merged with a competitor, Queen Carpets. This was brilliant. It fixed their broken relationships with retailers and created a new company with a whopping 35% market share. And the result? By 1999, profits were at an all-time high.
And get this, the guy running Queen Carpets, it was Julian Saul, Bob Shaw's childhood friend. And years before, when Bob had first told him about the retail plan, this is what Julian said to him. Talk about prophetic, right? Julian's wisdom was so valuable that after the merger, he became the president of the new Shaw Industries. Okay, so this brings us right back to Warren Buffett. Even with that incredible comeback in '99, if you looked at the company's 5-year history on paper, it looked awful because of that retail disaster. So when Bob Shaw and Julian Saul walked into his office in 2000, what did Buffett see that no one else did? Here's where Buffett's genius really kicks in. See, most people would look at these reported profits and run for the hills. But Buffett, he looked deeper. He knew those huge losses in '97 and '98 were because of one-time costs from getting rid of the retail mess. Those were mistakes that weren't going to happen again. So he mentally added those costs back. And when he did that, he saw the company's true underlying profit. And as you can see, the core business was actually incredibly healthy and growing like crazy. And this number? This is the real secret sauce. Once you clear away all that noise from the retail blunder, you find this incredible figure. In 1999, Shaw was making a 51.2% return on its tangible assets. You know, the actual money tied up in factories and machines. What that means is the company was a cash-generating machine. It didn't need to hold on to its profits to grow. It could just send that cash right back to its owners. So, the deal gets done, Berkshire forks over the $2.4 billion, and Shaw Industries is officially part of the Berkshire family. So, how'd the investment do? What happened next? And right out of the gate, this thing was a monster success, a total home run. For the first 9 years, just look at these pre-tax earnings. They soared, peaking at nearly $600 million in 2006. On average, Shaw was sending about $210 million in cash back to Berkshire headquarters every single year. And a huge reason why it worked so well was Buffett's famous management style. Basically, leave him alone. As he says here, he doesn't want to tell his managers what to do. He bought a great business run by great people, so he just let them keep running it. That let Bob Shaw and Julian Saul operate with the same fire and independence that made them successful in the first place. But then, 2008 happened, and after the housing crash, the picture gets a lot murkier. If you read Berkshire's annual reports, you can see the performance was pretty choppy. In some years, they struggle. In others, their earnings declined. And maybe the most telling number here is the employee count. It's steadily dropped from over 25,000 to under 19,000 today. It suggests the business has really faced some major challenges in the last decade or so. All right, so after going through this whole incredible roller coaster of a story, from a tiny dye company to a global giant, through a massive mistake and an iconic deal, what are the really big lessons we can take away from all this? So, a few big takeaways here. First, being the absolute lowest cost producer is a ridiculously powerful advantage, maybe even more powerful than a famous brand. Second, never, ever compete with your own customers. It is a war you just cannot win, as Shaw found out the hard way. Third, a great business doesn't automatically mean it's a great investment. You have to buy it at a good price. And finally, maybe the biggest lesson of all, from Buffett himself, learn how to look past the scary headline numbers and find a company's real underlying earning power. You know, at the end of the day, the Shaw story is just this amazing reminder that sometimes the most extraordinary value is hiding in the most ordinary, boring places. It really makes you wonder, doesn't it? In a world that is completely obsessed with the next big tech thing, what seemingly boring but amazing businesses are hiding in plain sight right now? Thanks for tuning in. You know, everyone knows Warren Buffett buys great companies, but how he does it? That's often way more interesting than what he buys. It's really not just about the numbers on a spreadsheet. So today, we're going to dive into a perfect example of this, the story of how Berkshire Hathaway bought this family-owned furniture store in Texas, and what it shows us about a business philosophy that's built on integrity, trust, and looking at the long game. And you know what? It all kicked off with this one super simple question. Back in 1983, after Buffett made a hugely successful deal to buy Nebraska Furniture Mart, run by the legendary Blumkin family, he asked them, "Are there any more at home like you?" Now, he wasn't just being nice. He was seriously on the hunt. This one question started a search that went on for years, all to find the absolute best family-run furniture companies in America. So this search, it led him to some absolutely incredible businesses. The Blumpkins pointed him toward 3 amazing retailers. Fast forward a dozen years, and Buffett buys one of them, R.C. Willey, out in Utah. So what does he do? He asks its owner, Bill Child, the exact same question. And you're not going to believe it. The same names pop up again. And one name in particular just kept coming up. A company down in Texas called Star Furniture.
Okay, so who was this company that kept getting recommended so highly? Well, to really get why Buffett was so interested, we've got to rewind the clock a bit, long before Star Furniture was even a blip on his radar. Their story is this amazing, multi-generational journey of pure grit and some really smart moves.
Believe it or not, Star started way back in 1912, and it wasn't even a furniture store. It was a grocery that, get this, accepted furniture in trade. Then, in 1924, a Russian emigre named Boris Wolff, who came to America with nothing, managed to scrape together enough money to buy a quarter of the business. His son Melvin ended up joining in 1950 after his dad had a heart attack, putting his own dreams of a law career on hold. And by 1962, a young Melvin Wolff suddenly finds himself in charge of a business that was, well, basically sinking. And their beginnings? Oh man, they were, let's just say, colorful, is putting it mildly. The original store was on the ground floor of this 3-story building. As Melvin Wolff joked years later, the other 2 floors were a hotel of some questionable repute. I mean, this quote just perfectly captures the company's humble and maybe slightly notorious start. I mean, just try to picture the situation Melvin Wolff walked into in 1962. It was absolutely staggering. The business was on the verge of going under. They had basically no money, a huge pile of debt, a negative net worth, and a giant local competitor that was blocking them from getting the good furniture lines. And to top it all off, the bank called and said, "We want our money back now." Honestly, it looked like there was no way out.
So, this was it, the moment of truth. Facing what seemed like impossible odds, Melvin and his sister, Shirley Tumim, who joined the company to run the design side, made a critical decision. They just knew, they couldn't win a head-to-head fight. They had to completely change the rules of the game. Right? So instead of trying to outmuscle the competition, they decided to outthink them. While the other guy was trying to be everything to everyone, this big, brute force approach, Star got surgical. They carved out a very specific, very profitable niche. They went after higher-income customers, offered them better style and way better service, and cleverly put their stores in upscale neighborhoods right on the major freeways. They called it being different by design. So, the big question, did it work? You bet it did. Absolutely. This strategic pivot was a home run. From being on the brink of total failure in the 60s, by 1997, Star had become this regional powerhouse with 12 stores doing over $100 million a year in sales. I mean, that is just a phenomenal turnaround story. Okay, but here's the thing about success. It often brings a whole new set of challenges. Melvin Wolff and his sister Shirley had their family's entire fortune tied up in this one business. So they started thinking, what happens next? Not just for them, but for the hundreds of people whose jobs depended on Starla. They knew they needed to find a permanent, safe home for the company they'd built from scratch. And look, this wasn't just about them wanting to cash out and sail off into the sunset. They were really worried about keeping the company's culture alive and, just as importantly, protecting their employees. They were terrified that if something happened to them, estate taxes could force a quick sale, potentially destroying everything they had poured their entire lives into building. So, naturally, they looked at the usual options, an IPO to go public, or maybe merging with a bigger chain. But both of those routes threatened the very things they cared about most, Star's special culture and its ability to operate independently. And that's exactly why Berkshire Hathaway, with its totally hands-off approach, started to look like this really unique, really appealing option. So after hearing about Buffett's unique style for years from his buddies at Nebraska Furniture Mart and R.C. Willey, Melvin Wolff finally decides, okay, I'm going to make the call. He actually went to the 1997 Berkshire shareholders meeting, and just a few days later, he and Buffett were sitting down in a hotel room in New York, ready to talk. And this right here is where the story gets just wild. How long do you think it takes to sell a company doing $110 million a year? You'd think months of back and forth, right? Teams of lawyers? Nope, not with Buffett. They shook hands on a deal in 2 hours and 20 minutes. But wait, it gets even crazier. The amount of formal due diligence Berkshire did? 0.
as in nothing. They didn't audit the books, they didn't check the leases. Nobody from Berkshire even set foot in the place before the deal was done. The whole thing was based on the financial statements and, more importantly, a handshake. And this quote just says it all, doesn't it? It's Buffett's entire philosophy in a nutshell. Yeah, the numbers had to work, but for him, the character of the person he was buying from was everything. He knew Melvin Wolfe was a man of integrity, and in his mind, that was all the due diligence he needed. The whole thing, the entire deal, was built on one thing: trust. And you know what? Buffett's gut feeling was proven right, like immediately. As soon as the company was sold, Melvin and Shirley took $1.6 million of their own money from the sale and gave it to their employees as a thank you. Think about that. For every year you worked there, you got $1,000. What a gesture. For Buffett, that one act of generosity just sealed the deal. It was all the proof he needed. It showed exactly the kind of character he had bet on. As he later wrote to his shareholders, this is precisely the kind of partner he and Charlie Munger are always looking for. It's not just about spreadsheets, it's about finding good people to be in business with. So, okay, you've just sold your life's work to Warren Buffett. What happens now? You're probably thinking, here come the corporate suits, the new rules, the endless meetings. But with Berkshire Hathaway, the reality is the exact opposite. And this unique approach is how he's built such an incredible empire. Buffett's method is actually pretty simple on the surface. He buys great companies run by great people, and then he gets out of the way. There's no forced integration, no synergy PowerPoints, no top-down orders from headquarters. The management teams just keep running your businesses like they still own them, with total freedom. The biggest change is that any extra cash they generate goes back to Buffett, so he can put it to work in other great businesses. And the results of all that trust and freedom? Just explosive growth. Once they were free from worrying about financing and could just focus on running the business, the team at Star doubled the company's revenue. Doubled it in just 3 years. That's the power of this model. I love this quote from a speech Melvin Wolfe gave later on. It just perfectly sums up the kind of mindset that got him through everything. He saw challenges not as dead ends, but as chances to find a hidden opportunity, a new way forward. It's the philosophy that saved his company back in 1962 and ultimately made it exactly the kind of business Warren Buffett was looking for. You know, even after the sale, after becoming a multimillionaire, Melvin Wolfe said he was always asking himself that one question: what's the next goal? He wasn't working for the money anymore. He was working because he felt a responsibility to Berkshire shareholders. And he just had this immense pride in building the best company he possibly could. So this whole story kind of leaves us with a really simple question to think about in our own lives, in our own work. What's yours?
All right, picture this. You've got to take one of the most famously boring errands on the planet, buying a couch, and somehow turn it into a theme park adventure that your kids would literally beg to go on. Sounds impossible, right? Well, that is the incredible story of Jordan's Furniture. We're going to explore how this small family business became so legendary, so ridiculously fun, that it caught the eye of the world's most famous investor.
Really think about it. The biggest challenge in retail is just getting people through the door. Now, on top of that, add a huge, stressful purchase, and then drag along a couple of kids who would rather be doing, well, anything else. It's the classic furniture shopping nightmare. So, how on earth do you flip that script? How do you get kids to actually ask their parents to go look at sofas?
Well, you do it like this. You build actual Mardi Gras parades inside your store. You install honest-to-goodness IMAX 3D theaters. You put in the world's largest indoor ropes courses and put on these dazzling laser light shows. You see, you don't just sell furniture, you create a destination. This place wasn't just a store, it was an event.
So, here's how we're going to break down this amazing story. First, we'll tackle that crazy question: a furniture store with an IMAX? Then we'll meet the two brothers behind all the magic. After that, we'll get into how they basically invented shoppertainment. Then comes the legendary handshake with Warren Buffett himself. And finally, we'll see how Jordan's became a crown jewel in the Berkshire Hathaway empire.
You know, it really does sound like the start of a bad joke, doesn't it? But that question gets right to the heart of their genius. In an industry just filled with beige showrooms and pushy salespeople, Jordan's made a decision. They decided to be a theme park that just so happened to sell some furniture. And that one radical idea completely changed the game in a very, very traditional industry.
So where did a wild idea like this even come from? Well, it came from family. Specifically, it came from two brothers who took their grandfather's business legacy and just injected it with a massive dose of showmanship and a real, genuine love of fun. So, let's meet the Tatelmans.
The story starts out like a lot of classic American businesses. You have grandfather Samuel, who started selling furniture from a truck way back in 1918. A decade later, he opens the first store. Then his son, Edward, carries the torch from the 40s onward. And look, it was a solid, traditional business, ran successfully for over 50 years. But everything, and I mean everything, changed in 1973. That's when the third generation, the grandsons, Elliot and Barry Tatelman, took the reins.
And these two, wow, they were the perfect combination, a real yin and yang. Elliot, he was the business mind, the practical anchor, totally focused on the merchandising, the systems, the nuts and bolts of the operation. Barry, on the other hand, he had studied drama. He was the creative showman, the promotional visionary who saw the store not as a showroom, but as a stage. Together, they were just unstoppable.
But here's the thing. Their real secret weapon wasn't just their different skills, it was their mutual respect. Barry's whole philosophy was simple. Family always, always comes first. What that meant was they could try one brother's idea, and if it didn't work, they'd try the others, and ego never got in the way. That deep foundation of trust is what let their crazy creativity really take off.
Okay, so with the brothers in charge, they just started rewriting the rules of retail. They looked at this boring, high-pressure world of furniture sales and basically decided to do the exact opposite of what everyone else was doing. They didn't just want to sell furniture. They wanted to invent an entirely new category they called shoppertainment.
And this is how they pulled it off. First, they got rid of all those phony, one-day-only sales. They just felt it was dishonest. Instead, they offered one fair price all the time to build real trust. Second, they made their advertising fun. They starred in their own goofy, self-deprecating commercials that made them local celebrities. And third, and this is huge, they treated every customer like family. We're talking free popcorn, clowns for the kids, and a friendly, totally no-pressure environment.
And get this, here's the proof that their wild strategy actually worked. The typical furniture store was spending about 6% of its revenue on ads. Jordan's? They achieved legendary fame while spending just 1.5%. So why the huge difference? It's because their reputation did all the heavy lifting for them. The experience they created was their best advertisement, generating priceless word of mouth that built a belief in the company, not just in the price tag. And they just kept upping the ante. I mean, it started with a flight simulator-style movie ride. Then came an indoor Mardi Gras parade with animatronic jazz legends like Louis Armstrong. Then they bought and installed a beloved local Christmas display. They added IMAX theaters, these massive indoor ropes courses, and incredible water and laser shows. Every new store was a chance to top the last one, making a visit to Jordan's an absolutely unforgettable experience. All of this, the fun, the trust, the incredible sales, it all built to the ultimate validation. With sales per square foot that were the highest in the entire country, this quirky, fun-loving company from New England finally got the attention of the most respected investor on the planet, Warren Buffett.
And what's crazy is that Buffett was already impressed before he even walked in the door. The CEOs of his other furniture companies had been telling him about this place. But after he took a tour of their store in Natick in 1999, he was completely sold. He saw the energy, the happy employees, the smiling customers, and he just called the company a gem.
The way the deal actually went down is almost as legendary as the company itself. So, the brothers sent their financial statements to Buffett. A couple of days later, Buffett sends back an offer. And that was it. There was no army of lawyers, no lengthy audit that dragged on for months. It was a simple agreement based purely on Buffett's trust in the brothers and the incredible business they'd built.
As Barry Tatelman put it so perfectly, the whole deal was based on, quote, a new concept in business. It's called trust. See, this wasn't just a financial transaction. It was a deep alignment of values. Buffett doesn't buy companies to change them. He buys great companies to let them keep being great. And the Tatelmans knew he would protect the unique culture they had spent their entire lives building.
Now, the official price was never disclosed, but analysts at the time estimated the sale was somewhere in the ballpark of $200 to $300 million. Just an incredible outcome for a business that started with their grandfather selling furniture from the back of a truck.
But what happened next is what really tells you who these guys were. After the sale closed, Barry and Elliot took $9 million of their own money and gave it directly to their employees. Every single person who worked there got 50 cents for every hour they had ever worked for the company.
It was just a stunning act of generosity that proved their whole family-first culture was way more than just a slogan.
So what happens after the big handshake? I mean, for a lot of companies, getting acquired by a giant is kind of the end of the story. But for Jordan's, it was really just the beginning of a whole new chapter, one where they had the financial backing to take their incredible vision even further than before.
So the day after the deal closed, the brothers call up Warren Buffett and ask, "Okay, so what do you want us to do now?" And his answer was just so simple. Just keep doing what you've been doing. He bought the magic, and he had absolutely no intention of interfering with it. It's that classic Buffett, hands-off approach.
And boy, did they. Fueled by Berkshire's capital, they opened up new superstores all across New England. They launched these legendary promotions, like the famous one where they refunded over $30 million to customers when the Red Sox won the World Series, a massive risk that, of course, was very smartly insured by another Berkshire company. And most importantly, the family legacy is still going strong, with Elliott's sons, the fourth generation, now helping to lead the company.
So, after all that, what can we learn from this incredible story? Well, the lessons are pretty timeless. First, differentiate yourself. Make your business an experience, not just a transaction. Second, understand that the intangible things, like a fun reputation and community trust, are actually your most valuable assets. Third, build all your relationships on a foundation of respect. And finally, just plain decency is a winning strategy. Being good to people isn't just a nice thing to do, it is good for business.
And that leaves us with a really critical question for today. In our world of one-click online shopping and automated checkouts, the Jordan's Furniture story is this powerful reminder. It forces us to ask, in an age dominated by algorithms and e-commerce, what is the true bottom-line value of a genuine human smile?
So, how does a family business manage to not just survive, but truly thrive for over 100 years? I mean, so much so that it catches the eye of one of the greatest investors of all time? Well, today we're going to dive into the amazing story of Ben Bridge Jeweler. This is a company that chugged along for 88 years before, Berkshire Hathaway came knocking. It's a fantastic tale of slow, deliberate growth, unbreakable family bonds, and one powerful guiding principle that shaped every single move they ever made.
And really, it all boils down to this. This one quote from Herb Bridge, who was the second-generation leader of the company, well, it's the key to the whole thing. This wasn't some corporate slogan he put on a poster. He called it his lifelong moral compass. So what in the world is this principle that guided 5 generations of this family?
The word is tzedakah. Now, this is a Hebrew term, and it goes so much deeper than just writing a check for charity. It's this incredible mix of justice, fairness, and this deep-seated duty you have to look out for your neighbor. For the Bridge family, this wasn't some abstract concept. It was basically the DNA of their family, passed all the way down from their ancestors in Poland to a boardroom in Seattle.
To really get the weight of this, we have to go back, way back. See, this story doesn't start in some fancy jewelry store. No, it starts in Poland under the thumb of the Russian czars, where just surviving often meant relying on the kindness of the community around you.
Okay, I want you to just let this timeline sink in for a second. The family patriarch Joseph gets to America in the early 1900s. His son, Ben, officially starts the company in 1927. But now, look at this. Fast forward all the way to 1983. That's 56 years later. And after all that time, they still had only one store. Think about that. This was never about explosive, get-rich-quick growth. It was about building something to last, something with deep roots built on a foundation of pure trust.
The founder, Ben Bridge, was tzedakah in human form. I mean, during the absolute worst of the Great Depression, when companies were failing left and right, he made it a point of honor to pay every single bill in full on time. People knew he'd lend money to folks who were struggling, even if he probably wasn't getting it back. This wasn't just a smart business tactic, it was who he was. And that character built a reputation that would become the company's most valuable asset.
So as the business moved on to the second generation, to Ben's sons, Herb and Bob, it hit a major roadblock. But this wasn't about a competitor or a bad economy. No, this was an internal crisis, the kind that could have ripped the whole family and the business right apart.
You see, Herb was this creative, ambitious guy, and he was ready to take the business to the next level. But his dad, Ben, the man who built it all from nothing, was, and I'm quoting Herb here, the quintessential micromanager. Ben had his system, and he was not about to change it. You can just feel the tension, right?
Herb said it was like a collision between two bulls. Things were getting pretty explosive. And this leads to a question that has broken countless family businesses. What do you do? I mean, seriously, what's the move? Does the son walk away to do his own thing? Does the father just clamp down and stifle the next generation? How do you keep the family from falling apart when the business itself is the thing pulling you in opposite directions?
The answer? Well, it was absolutely stunning. After Herb finally told his dad he was planning to take another job, Ben called a family meeting, and he said these words, "Herb, you are not leaving. It's me who's leaving." At just 58 years old, full of energy, Ben Bridge retired on the spot. I mean, can you imagine? That is an absolute masterclass in putting your family's future ahead of your own ego. He chose unity over control, stepping aside so his sons could finally step up. It was an incredible sacrifice that cemented that family-first idea into the company's soul forever.
Okay, so with Herb and his brother Bob now in charge, the era of that one, single, cautious store was officially over. But their reason for expanding, well, it was totally unique, and it lined up perfectly with the values their father had just shown them.
And here it is. This is the part that makes them so different. Get this, they didn't expand to get rich. They said they could make a great living with just a few stores. No, they expanded because they had these amazing, loyal people working for them, and they wanted to give them a real career path, not just a job. They wanted to be able to say, hey, come grow with us. Growth was just the vehicle for taking care of their people.
And man, were they smart about it. They didn't just rush in. First, they actually ran some anonymous discount counters just to learn how high-volume sales worked. Then, and this is just genius, they agreed to operate 7 jewelry departments inside of JCPenney stores. Think about that. It was like getting a free PhD in how to run a chain and operate in a mall. It was only after all that prep work that they finally opened their second official Ben Bridge store in 1968.
So where did all of this patient, purposeful work lead? Well, by 1990, that slow and steady approach had resulted in this number, 39 stores. And it was right around then that Herb and Bob passed the torch to the third generation, their sons, John and Ed, who took over as co-CEOs.
So under John and Ed, the company kept on its impressive path. But by the late 90s, the family was facing a whole new kind of challenge. You've got multiple family members with stock, you've got estate taxes to worry about. They needed a plan for the future, a plan that would protect the company's legacy without, selling its soul. This is what got them noticed by the big leagues. Just look at these sales figures. You can see here they had this amazing track record of consistent double-digit growth. But then, look at 1998, a staggering 21% jump in a single year. When a family friend sent the company's appraisal over to Warren Buffett in Omaha, well, these are the kinds of numbers that make him pick up the phone.
But they weren't just talking to Buffett. Another buyer, a competitor in the jewelry world, came in with a much higher offer. We're talking about 20% higher. And this slide really lays out the choice they were staring at. Take the higher price, and you almost guarantee your culture gets wiped out, your headquarters gets moved, and your loyal people, well, who knows what happens to them. Or you could go with Berkshire Hathaway. A fair price, sure, but with a rock-solid promise to preserve everything they'd spent decades building.
For the Bridge family, this wasn't even a hard choice. This was the ultimate test of tzedakah, right? As Herb said, we had people who'd been with us 35, 40 years. These people were family to us, and we weren't about to sell them out to the highest bidder. It was that simple. They chose their people. It was a decision that was basically a century in the making.
And what happened right after the deal was done is it's pure Buffett. The family asked him, okay, when are your teams coming in to check the inventory to audit the books? And his response was legendary. He just said, I don't do due diligence. I don't need that. I wouldn't have bought you if I didn't trust you. See, he wasn't just buying great numbers. He was buying a reputation, a culture of integrity that he knew was the real deal.
But hold on, the story is not over, not by a long shot. Because what the third generation, John and Ed, did next, this might be the most remarkable part of the whole story. From the money they got from the sale, they set aside this amount, $9 million.
And this wasn't just some random bonus. It was so thoughtful. Their logic was just so simple and so right. The people who helped create the wealth should get to share in the wealth. They worked out a whole formula to give every single employee a bonus based on how long they'd been there and their position. And they paid it out over 2 years, which was smart, right? It encouraged everyone to stick around through the transition. It was the ultimate way of taking care of your neighbor.
So what happens after you sell your family's legacy to a billionaire? I mean, for a lot of companies, that's where the story just kind of ends. But for Benbridge Jeweler, it was really just the start of a new chapter, one where their values would just keep on shining.
And Buffett absolutely kept his word. As you can see here, almost nothing changed. The family kept running the show, eventually passing the leadership on to the fifth generation, Lisa Bridge. They had total autonomy. Buffett famously told them, "We don't delegate, we abdicate." They had the financial backing of a fortress, but they still grew in that same prudent, purposeful way. Berkshire was the perfect home for them.
So what are the big takeaways from this incredible story? Well, first, that being kind and ethical in business, that's a strength, not a weakness. It's a real competitive advantage. Second, that slow, steady, purposeful growth, that's how you build something that lasts. Third, that family unity is worth more than money or control, period. Fourth, a good reputation is one of the most valuable things you can possibly own. And finally, and maybe most importantly, doing right by your people is a much better return on investment than just cashing out for the highest price.
We're going to leave you with this one last thought from Herb Bridge. This was his definition of success, and it just perfectly captures the 100-year legacy of his family's company. And it leaves us all with a question to think about, right? In our own jobs, in our own lives, how are we defining success? Is it about what we can get for ourselves, or is it about what we can help create for others?
All right, let's get into what has to be one of the weirdest but most brilliant business stories you'll ever hear. We're talking about the American West, a couple of legendary Texas brands, and, you guessed it, one of the greatest investors of all time. Welcome to the story of Buffett's Boots and Bricks.
So right off the bat, here is the central puzzle. In the year 2000, Warren Buffett, a guy famous for his focus, buys a company that makes cowboy boots and bricks. I mean, what? It seems to fly in the face of everything you learn about business synergy. But, as we're about to see, there was some serious hidden genius at play here.
And look, this wasn't some tiny experimental purchase. We're talking about over $500 million in cash. So you got to ask, what on earth did Buffett see in this odd couple of a company to make it worth that kind of money? Well, to figure that out, we have to go way back and understand where these two businesses came from.
You see, Justin Boots and Acme Brick weren't just companies. They were basically institutions, forged on the Texas frontier. Their stories are these classic tales of American grit and ingenuity, and they were woven into the very soul of the region.
So picture this, it's 1879. A guy named H.J. Justin shows up in a dusty Texas town with a grand total of 25 cents in his pocket. A friendly barber spots him, lends him $35, and just like that, Justin Boots is born. Now, fast forward 12 years, not too far away, another guy, George Bennett, finds the perfect spot of land. It's got shale, it's near coal, and it's right next to a railroad, and he starts the Acme Brick Company. For decades, these two grow into absolute giants in their own right. Then, in 1968, they decide to merge, and that single decision sets the stage for Warren Buffett's phone call in 2000. And this right here, this quote from the founder, it tells you everything you need to know. This was never just about making stuff to sell. It was about creating a standard, an identity, a piece of the true West. You know, this obsession with quality and brand, that's exactly the kind of stuff Buffett drools over. It's a promise that doesn't fade over time.
But this story isn't just about iconic founders. Every great story needs a hero, right? Well, the guy who bridges the gap, the man who really matters here, is the founder's grandson, John Justin Jr. He's the one who had to stare down the barrel of total failure and somehow managed to pull off an incredible comeback.
Yeah, that merger in '68, the one that was supposed to be this huge victory lap, it was nearly a complete and total catastrophe. The new company was just hemorrhaging cash. We're talking extravagant spending, a botched IPO, just one terrible decision after another. For John Jr., his entire family's legacy was hanging by a thread.
And you can just feel the weight of it all in his own words. This wasn't just some problem on a balance sheet. It was a deep, personal crisis. He literally talks about being so overwhelmed he had to lean against a street sign just to keep from fainting. The pressure must have been absolutely immense.
But you know what? He didn't break. He fought back. He basically staged a boardroom coup, forced out the old guard, and took over as CEO. And he didn't just manage from an office. No, he put on jeans and boots and went down to the plants to work side by side with the guys loading the kilns so he could learn the brick business from the inside out. He made the gut-wrenching call to scrap their entire shoe business and get back to what made them famous, cowboy boots. And then, and this is the genius part, he made a crazy, counterintuitive bet. During a housing slump, when nobody was buying bricks, he kept the factories running full tilt, building up a massive inventory. And when the market finally roared back to life, guess who was the only one ready to sell? Acme. Sales went through the roof.
Okay, let's jump forward to the year 2000. John Jr. is now in his 80s, his health is failing, and he knows he needs to find a permanent home for the company he saved. He decides to sell, and eventually, word of this quirky Texas company makes its way to a certain office in Omaha, Nebraska.
And this is where you really see the Buffett difference. It's just fantastic. So the company chairman asks Buffett if he's going to send in his teams of accountants and analysts to tour the factories. And Buffett's response is just classic. He says, I don't have anybody to send. If anybody's going to come, I'm going to have to come myself. No army of suits, no months of poring over spreadsheets. Just Warren, coming down to Fort Worth to sit down and talk to the people who actually ran the business.
So they hand him this packet of information. And what's the very first thing he looks at? Not profit margins, not revenue growth. He flips to the page on employee tenure. Think about that. 27 years on average for finance folks, almost 22 years for people in production. That one stat told him everything he really needed to know. This wasn't just a company, it was a family. It was a place people came to and stayed at for their entire careers.
Okay, now this is the slide where it all clicks. This is the big aha moment. So look at the revenue on the left. Boots and bricks. Yeah, they look pretty comparable, right? But now look at the operating profit on the right. Whoa, the bricks business is this incredibly consistent, powerful profit machine. Meanwhile, the boot business, it often lost money or barely broke even. The boots were the famous brand, the thing everyone knew. But the bricks were the bank, and Buffett saw it instantly.
So let's break down Buffett's whole thesis here. 1, you've got 2 iconic, century-old brands that people love and trust. 2, you have management that is proven passionate and unbelievably loyal. 3, and this is a huge one, you have a powerful economic moat. See, bricks are super heavy, which means they are crazy expensive to ship. So Acme had this massive built-in cost advantage over any competitor within about a 250-mile radius of its plants. And 4, you put all that together, and what do you get? Enduring, long-term value that isn't going anywhere.
And here's Buffett himself, just laying it all out. Notice what he's highlighting. He's making a promise, continuity. He's not buying this thing to break it up or change it. He's buying it to protect it. The same people who built it are going to keep running it. This promise is the secret sauce for why so many great family businesses choose to sell to Berkshire. All right, so what happened next? What's the legacy of this deal? What can we learn from this strange marriage of boots and bricks? Let's take a look.
Well, under Berkshire's umbrella, the company had the financial firepower to keep doing what it did best. Think for the long term. When the 2008 housing crisis hit and wiped out so many of their competitors, Acme was able to weather the storm and prepare for the recovery. And in a bittersweet ending, John Justin Jr. passed away less than a year after he sold the company. But he died knowing that the business his grandfather started with a quarter in his pocket was finally, truly safe forever.
And you don't have to take my word for it. Listen to this quote from an insider, the VP of Finance. He basically says that being part of Berkshire freed them. It gave them the ability to manage this wonderful business for the long haul, without constantly stressing about hitting next quarter's numbers. That's the Berkshire effect. So when you boil it all down, what are the big takeaways here? Number 1, if a business is great, leave it alone. Trust the people who made it great. 2, look for those hidden advantages, like the geographic moat Acme had. 3, remember that deals are about people. Their character and history matter more than any spreadsheet. 4, know what your core strength is and double down on it. And finally, number 5, play the long game. Always. Build your business to last, not just to look good for the next earnings call.
And that really leaves us with one final thought. You know, we live in this age that's just obsessed with tech, with speed, with constant disruption. But the story of Justin Industries is this powerful reminder that some of the most important business principles are incredibly simple, they're durable, and they're absolutely timeless. So the real question is, what can we learn from some simple boots and bricks to apply to our own world today? That's definitely something worth thinking about.
You know, Warren Buffett is famous for his hands-off approach. It's his whole thing. He buys great companies and then trusts their management to keep doing what they do best. So what on earth would it take for him to personally step in and fire a CEO? Well, it actually happened. And the story behind it is an absolute masterclass in business, integrity, and, believe it or not, the true meaning of a promise. So let's dive into the story of the promise that was worth more than $1 billion. Yeah, This is the central mystery we're unpacking today. And let me tell you, it wasn't about missing earnings for a quarter or a temporary dip in the stock price. No, this was about something way more fundamental, something that shook the very foundation of a century-old company and a billion-dollar investment. And there you have it, straight from the man himself. The reason for this incredibly rare and dramatic move wasn't hidden in some spreadsheet or financial report. It was all about a promise, a solemn promise that Buffett felt was about to be completely shattered. Okay, so here's how we're going to break this whole thing down. First, we'll look at the promise that was broken. Then, we'll explore the incredible company that inspired it, follow the billion-dollar deal, witness the betrayal that almost wrecked everything, see how Buffett delivered his reckoning, and finally, uncover the powerful lesson hidden in every single can of paint. This entire saga, the whole thing, really just boils down to a single pledge, a promise made when Berkshire Hathaway bought the company, and the explosive, dramatic consequences that followed when one leader decided to break it. But before we can even get to the broken promise, we have to understand the company at the heart of it all. To really get why this pledge was so critical, we need to rewind the clock and look at the unique culture and business model of Benjamin Moore. The history here is pretty remarkable. Founded way back in 1883 with just $2,000, Benjamin Moore built its entire reputation on just relentless quality and innovation. From a best-selling paint in the 1890s to a revolutionary color-matching computer in the 80s, they were always ahead of the curve. But the real secret sauce, the foundation of the whole business, was that incredible, dedicated network of thousands of independent dealers. And listen, these weren't just some feel-good corporate buzzwords slapped on a poster in the break room. These 3 principles, laid out by the founder himself, actually became part of the company logo. They defined the entire culture. Integrity wasn't just a goal, it was the brand. And that's the reason those independent dealers trusted the company for generations. So, you've got this amazing legacy company, right? Built on a rock-solid foundation of quality and trust. And around the year 2000, they're looking to sell. Well, one of the board members happened to know a guy who might be interested, a guy who prizes exactly these kinds of businesses. His name was Warren Buffett, and that introduction set the stage for a billion-dollar handshake. So Buffett and his partner Charlie Munger met with the leadership team. They loved the business, and they made a $1 billion all-cash offer right there on the spot. And we're not talking chump change here. This was a huge acquisition, and it showed just how much faith Buffett had in the Benjamin Moore brand and its unique way of doing business. And right here, you can see exactly what caught Buffett's eye. That steady sales growth on the left, that's nice, that's good. But the profit growth on the right, that tells the real story. Profits were accelerating like crazy. And why? Because Benjamin Moore wasn't just selling cans of paint. They were selling a premium product through a dedicated network of pros who gave elite service. That network, that was their economic moat, the thing that protected their incredible profitability. And this right here is the moment the whole story pivots on. Right after the deal closed, Buffett recorded a video that was sent out to all of those independent dealers. He knew they were the company's moat, the source of all its strength, and he made them a direct, personal, and solemn promise. Under Berkshire Hathaway, their business model was safe. The dealer system was forever. And for years, everything went great. But then, a new leader came into the picture. A leader who saw that powerful, profitable dealer network not as a strength to be protected, but as, well, a constraint to be broken. His name was Dennis Abrams, and he took over as CEO in 2007 with a totally different playbook. He was described as having an ambitious, impatient temperament, and he saw the slow, steady, careful growth of the dealer network as a roadblock. He was tempted by the siren song of the big box stores, the Lowe's and Home Depots of the world, thinking that was the key to fast, explosive growth. It's a classic temptation, right? Chase that massive short-term revenue spike, even if it might cost you everything in the long run. This slide just lays it out perfectly. It was a total clash of strategies. On one side, you have the Benjamin Moore way, loyal dealers, premium prices, and total dominance in a profitable niche. And on the other, you have the lure of the big boxes, just chasing massive volume, which always leads to squeezed profit margins and watering down a premium brand. It was a fundamental betrayal of the company's entire identity. And Abrams didn't just think about it. He acted. He secretly went after deals with big box retailers, totally undermining the independent network. He started strong-arming his own dealers, trying to force them to drop competing brands by threatening to open company stores right next to them. Then he cut the sales and advertising teams that supported them and started selling paint directly online. Every single one of these moves was a dagger to the heart of Buffett's promise. Now, you gotta remember, Buffett does not meddle. That is not his style. So how in the world did he find out that this promise he personally made was being systematically dismantled? Well, this is where the story takes a really dramatic turn. And here's the crazy part. On paper, things looked okay. The short-term profits were still coming in, which completely hid the rot underneath. As Buffett himself said, the numbers looked fine. That was the problem. The alarm wasn't raised by a spreadsheet, no. It was raised by the very people Buffett had made his promise to, the dealers. They started calling Berkshire's headquarters in Omaha, and the message finally got through. So, the second Buffett got wind of this massive deal with Lowe's that was about to happen, he moved fast. Abrams was out. Done. Now, rumors started flying that it was over some expensive yacht party, but Buffett shut that down immediately with an open letter. He made the real reason public and crystal clear. This was about a fundamental disagreement on strategy. It was about the promise. And if you want to see the real human cost of all this strategic chaos, just look at this chart. The damage was immense. From a peak of nearly 3,000 employees in 2005, the workforce just plummets to just over 1,700 10 years later. This wasn't just some disagreement in the boardroom. It was a period of deep, deep instability that gutted the company's workforce and its soul. And look, fixing this mess wasn't as simple as firing one guy and calling it a day. It was a monumental task. Buffett's first choice to replace Abrams, a guy named Robert Merritt, was also fired after just 15 months. He was reportedly seen as disrespectful to the company's historic culture. It just proves how deep the wounds really were. Fixing a broken culture of trust is never a quick fix. So after all that turmoil, how did they finally turn the ship around? Well, the answer, once again, comes back to Buffett and that original promise. He had to personally step in to restore faith and set the company back on its true course. Again, Buffett didn't just hand this off to someone else to clean up. He made a new video. He spoke directly to the dealers one more time. He owned the mistake, admitted how close they came to a complete breach of faith, and he publicly, personally, recommitted to the promise. As he put it, it's like breaking up with your girlfriend. It takes time to repair that relationship. This was the start of that repair. So when you boil it all down, this whole crazy story leaves us with some really powerful lessons that go way beyond just paint. First, integrity is everything. Second, you have to defend your competitive moat. Dominating a profitable niche is so much more valuable than chasing mass market volume. Third, always focus on long-term value, not short-term profit boosts. And finally, as Buffett showed the world, well, you can't always control your profits. You can absolutely be held accountable for keeping your word. Which brings us to one last big question to think about. The Benjamin Moore saga suggests that for the most durable, most respected businesses, the answer isn't when is a promise more valuable, but recognizing that a promise, when it's kept over the long term, is the very source of the most valuable profits you can get.
You know, when you think of Warren Buffett's biggest wins, you probably think of giants like Coca-Cola or Apple. But what if I told you one of his most incredible investments ever was a company you've almost certainly never heard of? A company that makes, well, grain silos and pig pens. Today, we're digging into the amazing story of CTB International and how this, let's be honest, kind of boring farm equipment company became an absolute home run for Berkshire Hathaway.
Okay, so let's set the scene. It's October 2002. Berkshire Hathaway scoops up this Midwestern business called CTB International. The price tag? A cool $140 million. For a company the size of Berkshire, that's a pretty standard, almost modest deal.
But this is where the story gets really wild. By the end of 2010, so less than 8 years later, CTB had already paid Berkshire $160 million in dividends alone. Think about that. They got their entire investment back, plus an extra $20 million just from the company's cash payouts.
And if that wasn't enough, during that same time, CTB also managed to completely wipe out the $40 million of debt it had on its books. This wasn't just a good investment, it was an absolute cash-generating machine right from the get-go.
So, the big question is, how on earth did this unassuming business pull off such an incredible performance? How did it go from a quiet manufacturer to a global powerhouse with sales over $1 billion? Well, that's what we're going to break down. We'll look at its founding mission, the trouble it ran into, and how getting bought by Berkshire totally supercharged its growth.
To really understand CTB, you have to go all the way back to its founder, a guy named Howard Brenbeck. His story starts in the heart of the Great Depression. His family lost everything when their bank failed, and he had to drop out of college to go home and help with the family hardware store. And that experience, well, it pretty much defined everything he did next.
See, Brenbeck spent his career in agriculture, and he knew just how brutal the work could be. So in 1952, he started a company called Chore Time with a really simple goal: make farm chores easier. A few years later, he started Brock to build better feed bins. Then he invented this game-changing device called the Flex Auger, which basically automated feeding for livestock. Finally, in '76, he put them all together to create CTB. This was a company born from solving real problems for real people.
And what I love is how he described his motivation. He said he just woke up one day feeling compelled to take action, like he didn't even have a choice. This wasn't just some guy chasing a business opportunity. It was a mission, and that sense of purpose was baked right into the company's DNA from day one.
All right, let's fast forward a bit to the late 1990s. By now, CTB is a successful public company, but it was about to hit some serious headwinds that, funny enough, created the perfect setup for an investor like Warren Buffett.
Just take a look at these numbers. That top line, sales, it's looking pretty good, right? Growing and then holding steady. But then look at the bottom line, net income. It is all over the place. It plunges nearly 35% in a single year, then bounces around. Now that kind of volatility would make any Wall Street analyst pretty nervous, but it was actually hiding the company's real strength.
So what was causing all this chaos? Well, it was basically a perfect storm. First, the U.S. hog industry completely cratered. Then, the Asian financial crisis hammered their international sales. Then, the U.S. egg market went soft. Farmers just weren't spending money, and as a result, CTB's stock price sank, making its investors really unhappy. But this is where our new CEO, Victor Mancinelli, steps in and stages this brilliant turnaround. He streamlined everything, cut costs, made the factories more efficient, and reorganized the whole company around its main customer groups. But the most important thing he did was shift the company's focus away from just chasing revenue, what he called empty sales, to making sure that every single sale was actually profitable. The result? Profits actually went up even while sales dipped for a bit. So you have this company with a volatile stock in a really tough industry. Why on earth did Warren Buffett want in? Because he's Warren Buffett. He looked right past all that short-term noise and saw exactly what he loves: a durable, well-run business selling for a cheap price. This slide really says it all. On the left, you've got that messy profit line we just saw. But look at the chart on the right, which breaks things down for 2001. The business was beautifully balanced. Its three main divisions, protein, grain, and international, all had big sales numbers, and crucially, they were all making good money. This wasn't a broken company at all. It was just a really tough company weathering a storm. And of course, Buffett would have looked at the balance sheet, and what he saw there was a rock-solid foundation. Assets were growing. The company's net worth, the shareholders' equity, was going up consistently, and the debt? Totally manageable. This company was financially conservative and built to last. Really, Buffett's own words sum it up perfectly. He saw a strong brand, a leader in a basic and essential industry. I mean, we all have to eat. And most importantly, he saw top-flight management in Vic Mancinelli, who had already proved he could steer the ship through rough waters. It was the perfect Buffett company.
So, buying CTB was a brilliant move. But what happened next is what turns this from a great story into a legendary one. As soon as CTB got under the Berkshire Hathaway umbrella and away from the short-term pressures of Wall Street, its growth just went into overdrive.
I mean, the numbers here are just stunning. By 2010, they had more employees, sure, but look at the sales per employee. It more than doubled. That's a massive leap in productivity. And total sales? They went from $233 million to over $1 billion. This wasn't just growth, it was an explosion. So what was the secret sauce? Well, in a word, acquisitions. With Berkshire's massive pile of cash behind them, Mancinelli and his team could finally go on the shopping spree they'd always wanted to. They started snapping up companies that made things like grain dryers, poultry heaters, and climate control systems, methodically building out a complete product line for their customers.
But their biggest and most strategic move was getting into meat processing. When they bought companies like Maine, a huge player in poultry processing, they totally changed the game. CTB was no longer just helping farmers raise the animals, now they were selling the equipment for the entire process, from the farm all the way to the processing plant.
And this is the real magic of being a Berkshire company. CEO Vic Mancinelli said that when he had an idea for a deal, he could call up Buffett, who would get it in minutes and give him the green light. That speed and trust allowed CTB to pounce on opportunities that other companies who'd be stuck in committee meetings for weeks would completely miss.
Okay, so as we wrap this amazing story up, what are the big lessons here? What can we learn from this quiet, boring company that delivered such unbelievably brilliant results? I think it boils down to 4 key things.
First, win by being obsessed with your niche. CTB stuck to what it knew for decades. Second, pour gasoline on the fire with smart acquisitions, but you have to be great at bringing them into the fold. Third, build a competitive moat by becoming a one-stop shop and getting so big that smaller players just can't compete on price. And finally, prove that you don't need to be a luxury brand to be a great business. A simple model of high quality at a low cost can be an absolute killer.
But in the end, this was always about more than just the money. In 2012, Buffett himself went and told the CTB employees, "You're helping feed the world, and nothing is more important than that." It brings everything full circle, right back to that powerful, human-focused mission that Howard Brembeck started with all those years ago.
Which leaves us with a final question to chew on. In a world obsessed with flashy tech startups, what companies are out there right now quietly following the same playbook? What are the boring but brilliant businesses of today, dominating their niche and creating incredible value, maybe right under our noses?